Earlier this week, the Bank of Canada announced that they were going to hold on their interest rate policy. Now, I'm sure a lot of people are delighted with the news, but in reality, the real question remains, when are these interest rates going to come down? Tiff Macklem spoke this week in Calgary, and we're going to be breaking down some of that speech and the question period later to try and pull out some information to figure out just when they could potentially come down. We'll take a look at the three main areas that the Bank of Canada is looking at in regards to inflation, like mortgage interest costs, core inflation, and then wage growth. And then we'll finish it off by figuring out if we can pull out from Tiff when potentially these rates could come down in the future. But if this is your first time here, my name's Nick and welcome to Ways to Wealth. In this video, I've taken some snippets from the speech and the question period and I've embedded them into the video. And what my plan is to maybe talk a little bit about what Tiff is saying, but also hearing from Tiff himself. I know it takes a lot of time to watch all of these independently. So my goal was to condense as much into a shorter period video so you get an understanding from what Tiff is saying directly. So we're going to start out at the beginning of the question period. The interviewer asked straight up, "Are we done yet?" Let's see what Tiff has to say.
Oh, we're not done yet. You don't think we're done yet? Raising rates. It's pretty interesting.
Well, I think the answer is we'll see. We're gonna take it one meeting at a time. As I just indicated, it may be the case that monetary policy is sufficiently restrictive to restore price stability. The economy has entered a period of slower growth. That is relieving price pressures. That's an important reason why we kept our policy rate at 5% yesterday. We know there's lags in the effects of monetary policy, but as I underlined, inflation is still too high. The downward momentum has slowed, and we are concerned that there's a certain stubbornness in the stickiness of inflation. Maybe we don't need to do more, but maybe we do. And what I really tried to outline in my remarks were a number of the things we're looking at to gauge that progress.
What Tiff is trying to say here is that we can see the finish line, but we're not there yet. We keep seeing in the inflation reports that there's areas that are still sticky, ones that aren't coming down to target. And target is definitely 2%. And he goes on to say he's watching certain areas. So I know we prefaced that at the beginning, but let's take a look at what the first area is that he's watching.
But we know that many prices, those for food, shelter, and many services, are not cooling in the same way. And recently, global oil prices have risen again, pushing up gasoline prices. This is expected to increase headline inflation in the near term. To capture the center of gravity in inflation, we use several measures to look deeper than this headline and assess the underlying trend in inflation. So let me explain the inflation measures we're looking at and why. First, we track measures of core inflation, which exclude large price changes, whether they're up or down, that can obscure the underlying trend in inflation. Core inflation is running around 3.5%. This is true of year-over-year rates, as well as more timely 3-month rates. And what that suggests is that inflationary pressures remain and downward momentum has slowed.
I think the best place to start here is to take a look at what the definition of core inflation is. So we'll jump over to the Bank of Canada website here, and we can see that it is the CPI excluding food, energy, and the effects of changes in indirect taxes on the operational guide. So what they're doing is they're taking those three components out of the overall CPI to see what the other areas of inflation are doing. And what is important with this is that Tiff started out that video segment by talking about gasoline prices being higher now. So he knows in the next couple of reports that is going to have a higher effect. He also talked about food being pesky. We're still seeing inflation in grocery stores, maybe not to the effect that we've seen before, but it is still persistent. And now all of a sudden, when he talks about core inflation, which excludes that side, still being at 3.5%, Well, his mandate is 2%, so we're still 1.5% off, and he's finding it hard to take the ball over the last 20 yards into the end zone. He still needs to get that down into range, and we're just not there yet.
Price changes tend to be clustered around the 2% target. When inflation went up last year, which is shown in the middle panel, the distribution of price changes shifted to the right. The average price increase was higher, and the range of price changes widened.
For me personally, I'm a visual learner, so I always like to see things in charts. And when I take a look at this one, it's pretty self-evident as to what Tiff is talking about. And what we're trying to do is we're trying to base all of the different areas which impact the CPI to be around that 2% metric. Now, that's kind of probably most reflected in December of 2019, but as inflation started to kick in, we start to see that graph shift to the right in 2022. But what is most important about what he's saying is we still have that problem today, in the sense that when we look at July 2023, there's still a majority of products that are experiencing inflation over that 3, 4, 5, 6% ratio. So just something to take into consideration, especially with what Tiff and the Bank of Canada have to do in terms of their job. But let's take a look at what he said about the second different area he's watching.
Now, the single price increase that is having the biggest impact on CPI inflation is mortgage interest cost. That's gone up as we've increased interest rates. And it's up about 30% relative to where it was a year ago. When you exclude mortgage interest costs from the CPI, what's left is increasing at around 2.5%. And that has led some to argue that inflation is effectively back at target. Now, look, it's true that if we hadn't raised interest rates, mortgage costs would likely be lower today. But inflation throughout the economy would be higher. Inflation would be a much bigger problem than it is today.
The mortgage interest cost is definitely like a double-edged sword, in the sense that it's increasing the CPI number on a month-over-month basis because of what Tiff and the Bank of Canada have done with the interest rates. Now, the way that Tiff is explaining this scenario is that if he did not raise the interest rates and then subsequently raise your mortgage variable or your interest rate on your mortgage, then realistically inflation would still be absolutely rampant. So it's a double-edged sword. It's something that is definitely going to impact us moving forward. And the area that concerns me the most is that there's so many fixed mortgages right now that are coming up for renewal, and it seems like this number could only potentially get higher. I know he said something of the effect of 30%, and it's definitely the biggest and ugliest number that does come out on the report, but it could even potentially get uglier as the months go on.
The labor market is also an important indicator of this balance between demand and supply in the economy. We're seeing signs that the labor market is cooling from overheated levels earlier in the year. This is allowing labor supply to begin to catch up with demand. Employment was roughly flat in July, marking the 5th time in the last 6 months that job growth has been below the pace implied by population growth. So far, we've been able to cool demand without unemployment spiking. As I outlined last November, the fact that job vacancies were at a record high meant we had scope to cool the demand in the labor market without causing a large surge in unemployment. Nearly a year later, what we can see is that job vacancies have indeed fallen significantly, with only a relatively small increase in the unemployment rate. Wage growth, in contrast, has yet to show clear signs of moderation, with most measures running around 4 to 5%. As the labor market continues to come into better balance, we do expect wage growth to slow. And that's something we're going to be watching closely for evidence that confirms this rebalancing in the labor market.
The job market is something that is under close scrutiny by Tiff and the Bank of Canada. And we've definitely seen some of the effects of monetary policy, aka the raising of interest rates, take effect on the number of jobs. So I know we did have a very good jobs report this past week, but in reality, the overlying or underlying connotation is that we're definitely on a downtrend, but I don't really want to speak about that specifically. What I do want to focus on is the point that he made about wage growth. wage growth being at about 4 to 5% a year, and something that the Bank of Canada really has to watch because it's the reason that CPI or inflation in the 70s and 80s peaked for a second time. Now, unions during that time frame and other people started to request more wages, creating more buying power, creating that excess demand that he keeps talking about, being able to pay the higher prices at the grocery stores for houses, cars, etc. And that caused the inflation rate to peak again, kind of in that 77 to 78 area. And that is definitely what Tiff does not want. So this is something that Tiff is watching extremely closely because it could lead to another bout of inflation happening in the next couple of years. So forget the job market for now. The reason that he's raising interest rates is to slow down the economy. These numbers will unfortunately be bad. But in reality, the area of concern is that wage growth, which he does not expand on too much. So there's three main things that the Bank of Canada is watching when they make these decisions. First is excess demand and supply. What is that core inflation number doing? And we can see that it's still persistent. Their target, 2%, and where it's sitting at today is 3.5%. So there's still more work to do for the Bank of Canada to get that back into range. Like I said before, we can see the finish line, but we're not there yet. And this is definitely something that they forecasted in the past couple months. We also have the mortgage costs in there. When they continue to raise interest rates, this number will continue to go higher. So they're fighting a double-edged sword in that matter. And the third one is wage growth. They definitely have to make sure that wage growth does not run rampant, because if people can afford to buy more things, it's going to kill that excess demand that they've been trying to tamper. So those are the three main things that we're watching. And we're going to try and figure out now, based on what Tiff is saying, about when interest rates could potentially come down.
As we get back, as there's clear evidence that we're really getting back to price stability, yes, interest rates should come down. We're not there yet. It's too early to be thinking about interest rate cuts. Because we're not there yet, but we will get there.
Okay.
But I think you're running businesses. I don't think you should expect they go back to where they were in the decade between the global financial crisis and COVID. They could well settle at something higher than what we saw in the previous decade.
So a new normal.
A new normal.
The Bank of Canada has a job to do. Their job is to keep CPI or inflation at a 2% target year over year. And Tiff isn't confident that inflation has flushed itself out of the economy. Once inflation is present, there is a chance that it could definitely ramp up again. But in reality, until the Bank of Canada is confident that they see no further inflationary risk outside or above that 2% target, then interest rates will remain higher for longer. And when he goes on to talk to the business people in the room, he makes it very clear that the cheap money that we experienced over the past decade is going to be no more. We should not be expecting as an investment community that the rates are going to go down to 1% or less. We should definitely expect that interest rates will normalize as to what they both coined a new normal. To get a better picture of when these rates could potentially go down, let's listen to what Tiff has to say.
But as I said, we take those fiscal plans, we put them in our models, we come to a judgment about the path forward for the economy. And in our forecast we put out in July, we have inflation coming gradually back to our 2% target around the middle of 2025. So we're getting there.
Now, I know there's a lack of confidence when the Bank of Canada says something, because we can rewind back a couple years when they said interest rates will be low for a very long time. And now we're looking at maybe the fastest pace increase that we've seen over a year period. So a lot of people are taking everything they're saying with a grain of salt. But in reality, I think this should be the expectation. Middle of 2025, we're going to see inflation persistent in our economy. And it's only up until that point that the Bank of Canada needs to feel confident that inflation isn't still around in any facet, that rates could potentially go down. Now, you may say the economy is going to fall off a cliff there's a recession that's going to happen in the next 6 months. Well, that's a different set of factors that the Bank of Canada isn't projecting right now. They're kind of projecting around less than 1%, even into the negatives of GDP, which we just experienced a couple weeks ago. But in reality, I think the expectation should be higher for longer. We should have the anticipation that rates won't go down until 2025, because we can kind of project and we can put this into our budget to make sure that we're protected. And if it does happen to come down, well, then we win. If it does happen to go higher, we're sort of protected, but we're under the realization and not kind of blindfolded in this expectation that rates are going to go down next year, because based on the trend that we're at today, I definitely do not see that happening. Now, just on another note, we saw some elected officials earlier this past week pen a letter to the Bank of Canada issuing them not to continue to raise the rates. They did have a quick little laugh at the end. We'll jump to that segment now.
And hopefully you don't get any more letters from premiers.
Just saying.
But I think the most important part is that the Bank of Canada is separate from the government officials. They don't really have too much of a say. The Bank of Canada's job is CPI. It's the federal government that takes care of the fiscal policy and the spending. Maybe they could clean up their own act on that side. But in summary, I think interest rates are going to remain around this period until 2025, or at least I will continue to have that expectation to build that into whether it's my personal budget, whether it's investing, or whether it's I'm going to make a big purchase and I know I'm going to have to pay a big interest cost. So let me know what your thoughts are down below. Do you see the Bank of Canada lowering before 2025? Are you projecting that the Canadian economy does go into a deep recession and we need to act fast with our monetary policy? Or could you see the Bank of Canada continuing to go higher? I hope you enjoyed this video. We cover the Bank of Canada all the time. If you do enjoy, I'll link some videos here that you can go check out. But I hope you all have a great week in the markets. Happy trading.